So we're going to take a look today at Citi's latest commodities call and look at why they're a little bit bearish on Brent crude. And then McDonald's, am I loving it or not? I think the stock's dropped a little bit. So we're going to take a look and see if there's any longer term opportunity there. And then finally, we're going to look at our trade in Takeout for today, which is to use technicals for execution and to focus more on the fundamentals for direction. Now, the only way you can get the best trading insights, education, and analysis each day is if you're here every day. So hit subscribe so you can get your daily trading edge. So yes, as you can see here, Citi expects commodities performance to remain divergent and possibly be volatile through the upcoming quarter. Excuse me. They hold a bearish view on oil and forecast Brent to average $82 per barrel in Q4 and $74 per barrel for 2024. My view here is really that they're looking purely at the futures curve, which is a much better way of looking at things, in my opinion, than what JP Morgan have been doing, which, Jamie Dimon came out and said that he expects oil to go to $150. I mentioned last week that I spoke with an oil market maker, and she actually suggested that the $120, $135 calls in Brent were actually printing money. So there was interest in the market getting up to that level at that time. However, this is very, very different to what the spot price will actually suggest. So at the moment, what we're seeing is because of the OPEC cuts in production, we're seeing the spot price be more elevated than the futures price. So the price of oil in the future, according to how the futures market is pricing it. And what that's known as is it's called backwardation. So generally, futures prices will show an increase. So let's say in 3 months' time, you would tend to see maybe $1, $2 over spot, depending on what the demand is. But the curve's actually in backwardation, so it's sloping downwards. And what this means is that future demand is not that great, and it's really just showing that there's a supply constraint in the spot price, so the current price. So I would argue that Citigroup's view on this is more correct, in my opinion, than JP Morgan's currently. And even if you look at a chart quickly, you can see probably where Citi are getting this view from. So they're looking at the fundamental side of things. They're looking at saying, okay, well, the economy is a little bit weak, and any kind of increase in production from OPEC would suggest that there would be a lower equilibrium of supply versus demand met. And what I mean by that is that the price is basically going to come down, okay? So if there were any supply to come online onto the market, it would mean that demand would be bought at lower prices. So they're probably looking now at, let me just get my drawing tool out if I can find it. I always say this, I used to work at TradingView and I still can never remember where the specific bits are. Here we go. So they're probably going to say that they're looking at, the 200 weekly moving average and the 200 daily moving average. Right around here, if you were to sort of average these out, if price were to come down, 200 daily would remain pretty flat if price were to start reverting. And this would just trickle on just up to here. So they're probably looking at a convergence of around there. So that's why they're talking about average prices. So they're looking at a moving average here. And this is probably where they're getting their view from. If they think that this price is likely to remain stagnant over here, then the moving average is going to remain around here, which gives you a figure of $82. So that's where I'd say they're looking at. And then the longer term, they're again looking purely at the 200 weekly moving average and saying, okay, because I think they mentioned it was going to be at around $74 per barrel for 2024, which kind of makes sense. The 200 daily is not going to be able to shift that much. So you're going to get a reading of around there. Sorry for my very dirty charts. But I hope that just describes where I think they're coming from here. They're looking at it from a technical perspective, but the direction is fundamental focused. So McDonald's, am I loving it? Well, at these prices, yes, I am, to put it quite frankly. It's also fantastic post-gym food if you've got nothing else, by the way. So don't listen to the naysayers about McDonald's. Just as long as you're not having it every day anyway. But yeah, to the chart and to the fundamentals of McDonald's, I like McDonald's because it is actually just a massive landlord. It's a very, in my ethical view, very demerit. However, you got to throw the ethics out when you're looking at markets. Unfortunately, a lot of people buy into ESG funds, but when you actually look at the composition of ESG funds, you tend to find that they're heavily dominant with car manufacturers, who naturally, just because they're net zero as a definition, it doesn't mean that they're not releasing carbon emissions, for example. So unfortunately, in the investing world, you do have to throw some of your ethical beliefs out. But McDonald's, I love them because their business is purely dependent on basically leasing land to franchise owners. I think it's something like 84% of their profits come from basically franchises, which is an insane amount of money. Because the other thing as well is that it's all kept in an ecosystem, right? So it's all kept within, you got to buy all of your products from McDonald's suppliers. So McDonald's make basically everything for their franchise owners, as well as, leasing the land to them. So they buy the land, and then basically there's a franchise fee, there's a leasing fee, there's all of these other fees that are involved with running a McDonald's business. And they basically get to put their brand on it all. But to the chart, and this is definitely related to the trading takeout of today as well, which I'm going to get onto. The chart is basically suggesting that we're at 3 standard deviations to the downside from the 2020 high to last year's high. So I've run it from here to here. I've excluded more recent data because you obviously want to see, where the limit is. And basically what we're looking at is, here's 3 standard deviations to the downside, another 3 standard deviations to the downside, and here. So effectively, we're now trading at the objective 3 standard deviation range to the downside. That is a fantastic signal to look at, possibly entering a bullish market. This is 2 standard deviations to the upside here. If you wanted to run it for 3, then what you do is, why is that? There we go. Is you double click there and then you click 3. And then that would show you the limit to the upside, which actually probably coexists better with the 2015 to 2020 range. That runs more parallel up here, more aligned up there. But from my perspective, McDonald's is one of those stocks that, for a long-term play, probably is just the perfect investable stock. It provides a dividend, and it, because people don't quite grasp that it's not necessarily just a burger making business. It is very much a land leasing business. But at the same time, it's still got the burger arm to not make it so susceptible to higher interest rates, for example. It's just perfect. Like, it's absolutely perfect as a business. And also it's got the brand appeal globally, not just in the US. So, the fundamentals are definitely backing the technicals on that one. So I'm loving it. I always do love McDonald's. I hold it personally. So not a recommendation, just something to really, really think about from a thematic point of view when you're investing. What does a business do that might not be so obvious to the everyday person? So today's trading takeout is really to focus on process more than anything. And the process that I tend to follow is probably 80% macro fundamentals, that kind of thing. And then when it comes down to execution, making sure that the technicals do align with basically where to do business. So it's not always the right time for me to action a macro focused trade. Because the technicals aren't aligning with where to actually execute and do business. So, for example, you see on the oil chart or even the McDonald's charts that I showed you, there has to be a reason or an area for me to actually want to do business. And the focus on the oil chart, for example, was okay, we've got the moving averages that are suggesting that the view of the banks is, or at least Citibank on oil, was saying that, okay, so they think that the moving average will be the place really to execute. It's backing up their fundamental view of the backwardation of the oil curve. The McDonald's chart was, from my view, was looking predominantly at there have been a sufficient move to the downside to lead to now perhaps a bullish market occurring. Because the fundamental view of McDonald's aligns with there being, a longer term increase in the price. So I think for me, there always has to be a technical backing for a market to move to do business at. So make sure that, when you are looking at technicals, it's aligned with where the technicals are good to do business at, with the fundamental backing of direction.